The Federal Reserve just lowered interest rates for the third time this year, trimming the federal funds rate by 25 basis points to a range of 3.5% to 3.75%. This move follows earlier cuts in September and October. Sounds like relief, right? Lower rates usually mean cheaper borrowing, more market liquidity, and a potential lift to economic growth. But the reality this time may be very different and a lot more dangerous. What's happening now isn't a celebration, it's a warning sign. Because this rate cut, despite what it looks like on the surface, might not bring the boost people expect. In fact, it might actually make the economic picture worse. Let's break this down. Why the Fed's decision wasn't so clear-cut. Inside the Fed, things are far from unanimous. The decision to cut rates in December came with serious internal pushback. For the first time since 2019, three FOMC members voted against it, and not all disagreement pointed in the same direction. One official, Stephen Moran, argued for an even deeper 50 basis point cut, warning of mounting economic risks. Meanwhile, others like Austin Goolsbee and Jeffrey Schmid were firmly against any cut at all. They wanted to keep rates steady, cautioning that it might be too early to ease policy. That division is rare, and when the people steering the economy can't agree on where to go, it signals something bigger beneath the surface. Fed Chair Jerome Powell also made it clear this rate cut isn't part of a preset path. He stressed that there are strongly different views on whether more cuts should follow, and he even acknowledged that many believe the Fed should wait a cycle before easing further. This tells us one thing: the Fed isn't confident, and if they're not confident, that uncertainty trickles down through every corner of the economy. A shift in market expectations, and it's dramatic. Just weeks ago, a December cut was practically guaranteed. In mid-October, economists and traders were nearly unanimous. 97% believed the Fed would cut in December. Fast forward to late November, and the probability had collapsed to just 22%. The market flipped. Forecast tools like CME FedWatch started showing much more hesitation. Even Wall Street economists began expecting the Fed to pause, largely due to stronger than expected job data in September and the lack of reliable federal economic reports caused by a government shutdown. That rapid swing in expectations isn't normal. It shows just how fragile confidence has become and how uncertain the Fed's next steps really are. The Fed's dual mandate is backfiring. The Federal Reserve has two jobs: keep inflation under control and maintain healthy employment levels. Normally, these goals support each other, but not this time. Right now, the Fed is stuck between two forces pulling in opposite directions. On one hand, inflation is still above target, at 3% in September, and some forecasts are showing that tariff impacts could push it even higher into 2026. That means any easing could send prices climbing again. On the other hand, the labor market is softening. The unemployment rate has crept up to 4.4%, the highest since 2021. And while 119,000 new jobs were added in September, that headline figure hides some underlying weakness. Deferred resignations tied to the government's efficiency efforts are expected to drag October and November's employment numbers even lower. So here's the trap. If the Fed cuts rates too fast, inflation could rebound. If they hold rates steady for too long, job losses might accelerate and the economy could tip into a recession. Neither outcome is good, and there's no perfect middle ground. That's the dilemma, and that's why the Fed is walking a tightrope. Is inflation really under control? It depends on who you ask. Powell noted that, excluding the effects of tariffs, inflation is now closer to the Fed's 2% target. That sounds positive, but it doesn't tell the whole story. Headline inflation is still hovering around 3%, which means the average consumer continues to feel pressure. Groceries, rent, and energy costs remain elevated. And with new tariffs scheduled to phase in by 2026, there's an expectation that inflation could reaccelerate, especially if rate cuts increase demand while supply remains constrained. That's the key issue. Cutting rates makes money cheaper, which fuels spending. But when prices are already high and supply chains are still healing, more spending only adds pressure. If demand surges too quickly, inflation may not just persist, it could rise again. This is the inflation spiral the Fed desperately wants to avoid, but the December rate cut might bring it closer. The labor market is sending mixed signals. Look closely at recent job reports and you'll see something strange. In September, the economy added 119,000 jobs, more than double what many economists expected. On the surface, that seems like good news. But that jump might be misleading. Why? Because that same month, unemployment ticked up to 4.4%. That's not supposed to happen. More jobs usually mean lower unemployment. The rise suggests something else is going on. More people are entering the workforce, possibly because they're feeling the financial pressure of higher living costs. Others may be returning after leaving during the pandemic. And then there's the AI factor. Automation is slowly reshaping industries, especially tech and finance. While it hasn't led to mass layoffs yet, hiring in those sectors has slowed. This may not fully hit the jobs data until next year, but the trend is already forming. If AI-driven efficiency gains start replacing mid-level jobs, that could amplify the cooling in employment right when the Fed is trying to keep the labor market afloat. Now consider the ripple effects. A jump in workforce participation sounds like progress, but if job creation doesn't keep pace, that rising unemployment figure could stick or even climb. That changes the entire tone of the economic outlook. For the Fed, that creates a real challenge. A strong job number on paper doesn't mean labor conditions are healthy. It may just mean more people are looking for work because they have to. And if job openings don't grow fast enough to absorb that influx, the unemployment rate keeps climbing. That's why the headline number alone doesn't tell the full story. It's not just about how many jobs are being added. It's about who's getting hired, what industries are growing, and whether those gains are sustainable. The tech sector is a good example. AI is creating efficiencies, but it's also reducing the need for certain roles. That's slowing hiring in places that once led the job market. And it's not just Silicon Valley. Finance, logistics, even healthcare, all are starting to adopt AI tools that can replace or reduce human labor. Meanwhile, job growth is increasingly concentrated in lower wage sectors like hospitality, retail, and warehousing. These roles help the numbers look good, but they don't provide the income security needed to support long-term economic health. That's part of why consumers are still feeling squeezed. Even as jobs are technically being added, wage growth has slowed, and when combined with persistent inflation, real purchasing power is shrinking. And then there's job quality. A rise in part-time work or temporary contracts might mask deeper weaknesses. If people are taking multiple jobs to make ends meet or accepting roles beneath their qualifications, the labor market is clearly under pressure. This is why some economists say the job market is cooling, not crashing, but definitely not expanding with strength. And with borrowing costs still relatively high, businesses may continue to slow down on hiring heading into 2026. It's also worth noting that some layoffs may not have fully registered yet. Government shutdown-related delays, seasonal adjustments, and deferred resignations all play a role in shaping how employment data looks month to month. So the data might be lagging behind reality. And if that's true, the Fed could be underestimating just how fragile the labor market has become. The challenge is that jobs data is noisy, and by the time trends are clear, policy decisions may already be outdated. The Fed has to work with what's available, and that adds to the risk of acting too late or too soon. All of this means that 1 month's strong job report doesn't cancel out months of weakening indicators. Instead, it adds complexity to an already muddled picture. And that's exactly what makes this moment so dangerous. While the job market hasn't broken yet, it's not solid either. It's uncertain, inconsistent, and beginning to show structural shifts that go beyond normal economic cycles. The Fed's trap: damned if you do, damned if you don't. This is where everything converges. The Fed has made 3 rate cuts so far, with the December move bringing borrowing costs to their lowest since 2022. But that's not necessarily a win. If the Fed keeps cutting in 2026, Goldman Sachs sees 2 more 25 basis point cuts by June, there's a real risk inflation flares up again. The economy might overheat and prices could climb faster than wages. Purchasing power would erode, especially for the middle and lower income households already squeezed by debt and cost of living pressures. But if the Fed pauses, there's another risk. Higher interest rates could slow the economy further, leading to more layoffs, reduced consumer spending, and potentially a recession. Some FOMC members have said outright that it may be smarter to wait a cycle and reassess in early 2026. That would mean holding rates steady at 3.5% to 3.75%, not cutting again until March or later. So what happens? No matter which path the Fed takes, something breaks. Goldman Sachs versus the Fed. Conflicting visions. Goldman Sachs still believes the December rate cut was necessary. Their economists argue that the job market is genuinely weakening and that a pause would risk letting that weakness deepen. They also forecast two more cuts, one in March and another in June 2026, bringing the terminal rate to around 3% to 3.25%. On the flip side, Powell's latest statements were more cautious than many expected. He reiterated that the Fed isn't on a fixed path, and he emphasized internal disagreements among policymakers. Some officials are now vocal about pausing, pointing to the lack of updated government data and the need to see how the economy responds to earlier cuts. That difference in outlook highlights the uncertainty ahead. Markets want clarity, but the Fed doesn't have it, and neither does Wall Street. The pressure on policymakers is mounting. On one side are analysts warning of economic stallouts and hidden labor deterioration, and on the other are hawkish voices urging patience, fearing that cutting too quickly will undo progress made on inflation. There's also the psychological layer. The Fed doesn't want to appear reactionary. A rushed decision now could send signals that the central bank is panicking or losing its grip on the situation. That alone could spook markets. Then there's the complication of the government shutdown. With official labor data delayed or unavailable, the Fed has had to rely on alternative indicators and incomplete reports. That uncertainty makes forecasting much harder, increasing the chances of a policy misstep. Goldman Sachs believes the available data is already sufficient to justify a cut. Their view is that labor market softness isn't just a temporary dip, but part of a broader, ongoing trend. Waiting longer, they argue, could cause permanent damage. And yet, some inside the Fed are clearly uneasy. The divide between the doves and hawks is growing, with neither side holding a clear majority. That makes each future meeting more politically and economically charged. This division is being amplified by market noise. Traders are trying to price in every Fed whisper, every jobs report, every shift in inflation expectations. That volatility is creating feedback loops, where the Fed's moves shape markets and markets pressure the Fed. Meanwhile, everyday Americans are feeling the disconnect. Mortgage rates remain high. Auto loans are expensive. Credit card balances are climbing. Consumers were hoping for relief, and now they're unsure whether it's actually coming. That uncertainty bleeds into business decisions too. Companies don't know whether to ramp up hiring or hold back. Investors don't know whether to chase risk or retreat to safety. Even sectors like real estate and tech, which usually benefit early from rate cuts, are holding back. Developers are hesitant. Venture capital is cautious. It's not the rate cut that changes the game. It's confidence in what comes next. Without a cohesive narrative from the Fed, confidence remains fragile, and fragile confidence makes every policy shift more risky. So Goldman's bet is that it's better to act now, to front-load easing while there's still room to maneuver. Powell's side, meanwhile, seems to be saying, slow down, get more data, and don't risk reigniting inflation. That tension will define the Fed's playbook for the next 6 months. And whichever way the Fed leans next, markets will be watching closely. Because clarity isn't just nice to have anymore. It's essential. How markets might react in 2026. The Fed's path forward will shape everything from mortgage rates to stock market trends. If rate cuts continue in a non-recessionary environment, risky assets like high-yield bonds and the S&P 500 could rally. Historically, these conditions favor equity markets, especially if inflation stays contained. But if the cuts are happening into a recession, what JP Morgan calls recessionary easing, then things look very different. In that scenario, gold and treasuries outperform while stocks take a hit. The dollar index may also weaken, reducing the global appeal of U.S. assets. Right now, JP Morgan is leaning toward a mid-cycle, non-recessionary easing forecast. But that call depends heavily on how employment and inflation data evolve early next year. Any surprises could flip that outlook fast. This isn't a pivot, it's a gamble. It's tempting to see the Fed's recent moves as the beginning of a friendly monetary environment. Lower rates, more growth, stronger markets. But that would be the wrong takeaway. This isn't a pivot, it's a gamble. The Fed is betting that rate cuts will support the labor market without reigniting inflation. But there's no guarantee that this balancing act will work. The economy is sitting in what Powell described as a curious kind of balance. That balance is delicate, and it's being tested more with every decision. The Federal Reserve isn't navigating a runway. It's walking a tightrope over lava. Cut rates too fast, and inflation erupts again. Cut too slow, and the job market collapses. There's no clean way out. And with major divisions inside the FOMC, mixed economic data, and political uncertainty ahead, the Fed's next move could decide whether the U.S. economy lands safely or crashes hard. Right now, the odds aren't exactly comforting. If this breakdown helped bring clarity to a confusing economic moment, be sure to subscribe and like. Gumview Studio brings weekly, no-fluff content to help viewers stay ahead of economic trends, market risks, and what's really happening behind the headlines. Want to go deeper into the Fed's strategy, asset class responses, and global macro moves? Check out the next video queued up right here. Hit that subscribe button, and we'll see you there.